Hi there, I'm Rose Jacobs here with you for Kalkine Media. Before we get underway with this video, make sure you hit that bell icon at the bottom of your screen for all the hottest updates. Some great changes are lying ahead for the ASX across many sectors, and along with these changes are opportunities and risks. In today's episode, we're going to be looking at some major trends and risks expected on the ASX in the upcoming year. The ASX 200 has been delivering historic gains as Australia and the rest of the world continues to recover from the early pandemic blows. Let's check out the gains driven by strong economic growth across most developed nations. Over the past 12 months, the index is up 24%, setting a new all-time high on 13th of August. Experts have predicted that there are big changes ahead for the ASX across many sectors, including the buy now, pay later group Afterpay, which is being acquired by US fintech giant Square, which will then undertake a secondary listing on the ASX. One of the highly valued players and global equities managers, GQG Partners, intends to be listed and is tipped to be valued at more than a whopping $1 billion. Similarly, technology group SiteMinder is expected to hit the market in the upcoming year with a valuation north of $1 billion also. Some of the prominent players like neobank Judo, Vulcan Steel and New Zealand telecommunications company Orcon are also meeting with investors. The pandemic has spurred not only investment but also an explosion in startups, as well as historic levels of public and private market activity, from fintech and cryptocurrencies to autonomous vehicles and artificial intelligence. Today's inflation driving supply imbalances and inventory shortages, not to mention increasing sensitivity around cybersecurity, public health, geopolitics and shifting regulatory frameworks in China, have all added momentum to this trend towards domestic resourcing. What about the risky sectors? Tech has been an extremely fruitful sector in the recent past, especially with the advent of the pandemic. Experts have suggested to be very cautious on concept tech versus real tech. As experts warn, there is a lot of concept tech out there that can get you caught out. If you plan to invest your money in such concepts, there's a high chance that your bond yields turn up and the discounted rate of return increases. When you start modelling some of these earnings 5 to 10 years out, in today's dollar terms, they just simply don't stack up. It's also important to note that the infrastructure space is also expected to come under pressure, as the infrastructure has been often seen as a bond proxy. As bond yields increase, infrastructure stocks are going to become less attractive. Even more importantly, many of these funds are heavily geared. As interest rates turn up, it will have a material impact on their bottom line, and there's no way to hide that impact on those earnings. Moreover, the pandemic and related business closures led to reduced fossil fuel consumption and carbon emissions, and intensified pressure against investment in such energy sources. So the conclusion? Experts have been of the view that economic imbalances wrought by the pandemic might begin to ease, but the idea still remains doubtful since the unprecedented Omicron variant is here. It's also expected that the economic and market environment in 2022 can be decidedly reflationary, with higher economic growth and higher inflation, and eventually higher real interest rates. But that's a wrap for now. Please check out the website kalkinemedia.com for plenty more, and make sure you do like, comment, share and subscribe to the channel. I'm Rose Jacobs. Thanks for joining me.